Trade war fears taking the global markets by storm. In the past few months, the world's biggest emerging markets have seen a meltdown. Brazil and China plunging 35% and 24% apiece from their 52-week highs. European markets also suffered, with Italy down 20% from the highs. South Korea and Japan have seen significant drops as well. Amidst this global sell-off, our next guest says U.S. stocks are where you want to be. Let's go off the charts with Chris Verrone of Strategas. Hey, Chris.
Hey, Melissa, how are you? And yeah, I think when we look at EM right now, as we know, certainly a tough year. 52 back in January, all the way down to 42 today. I think the big question for investors is, does this spread home? Does this come home? Does this weakness show up with U.S. stocks? So I want to show you three charts that we believe continue to support the case for being long U.S. And the first is the fact that despite all the stress globally, the hedges here back at home really haven't worked. This is stocks relative to bonds. Stocks are making new highs relative to bonds. So defensive trades are not working. Stocks relative TLT. Along those lines, if we look at paper versus rock, banks relative to gold, very similar message. Sideways all year, just starting to break out. So another example of a risk-on asset, banks, breaking out relative to gold. We think that's a positive. And then lastly, if we look at the industrials, very important group in our work, a sector that was previously impacted by EM, this sector is actually getting better. This is a 3-month relative high for the industrials versus the S&P. This is names like Caterpillar and Deere. We think ultimately getting better. And we'll talk about one in particular. Here's Deere, DE, 30% correction this year. I thought very important bottom back here on August 17th on 3 times average daily volume. The stock is on the verge of breaking out of this downtrend. We think you get this above 148, it bodes well for industrials, it bodes well for the market. EM stress is not spreading home.
Chris, come on over.
Wait a second. Don't you poll the team?
No.
Should we have Chris come
Nancy,
to an executive decision?
Thank you, Nancy.
Great to see you.
Man.
So does this mean that there is a rotation going on, or a rotation that you would recommend? I mean, if we're going to value industrials, we're going to value banks. Is this at the expense of, say, technology?
Yeah, I think it may be, but these are sectors, both industrials and banks, that have quietly been improving really all summer. If you look at the response of the industrials post-earnings, it was the sector that really worked best relative to anything else. I think bellwether stocks like Caterpillar and Deere and Triple M and Honeywell, the transports have had a better tone about them here. We see the strength in the rails. We see the strength with the airlines. This is a sector that's getting better. Then you look at the banks. Bank of America back above 31, JP Morgan flirting with new highs. The regionals have acted well. So I think the punchline is the stress that we've seen from EM doesn't seem to be coming back home. And I think, if anything, some of the really shakeouts you've seen in some beaten down groups are probably viable here.
So how does tech look these days?
It's getting more narrow. I don't think it's finished. Frankly, the semis the last couple of days have been pretty good, despite some of the weakness that we've seen in the social names. I would also add some of the old line stocks, like a Cisco and a Qualcomm, actually improving here. So there seems to be a changing of leadership within tech. I don't think the sector as a whole is done quite yet.
So, Chris, when you look at emerging markets and when you look at EEM, which is heavily Asia dependent, you look at a stock like, and you drill down a little deeper, Alibaba, which has been the poster child for the tariff trade woes and everything else. Where do you think we go if that rips higher? You could see the equity market catch down in the U.S. to that market.
I'm not as quite convinced of that thesis. I would look at it this way. S&P up 8% roughly year to date. China down 20. I think it's pretty clear the market's perception of who's winning this trade war. I think if you look at the flows into EM, you've seen such an exodus of money over the last number of months. The bar for an upside surprise is probably pretty low as we move into the back half of the year here.
So let me ask you something like a CAT. If you're looking at that, has a lot of exposure outside of the United States. Does that then make it not one that you'd want to avoid for something?
Sure. I think what's really notable is the last week or two in particular, as EM has seemingly gotten worse, as Europe has gotten worse, CAT hasn't, right? So there seems to be an early message there that maybe the weakness in those parts of the world might be overdone.
All right. Chris, thank you. Good to see you. Chris Verrone of Strategas.
Breaking it down. You know, we do this. We do this. What is that segment we do on the show where you get a mitt and a ball? It's called Power Pitch. And Pedro over there, Power Pitch Caterpillar. A week or so ago, I lose track of time. I'm getting old, you know. But he mentioned valuation, and he mentioned, and we talked about the fact that they have this humongous stock buyback, $4.5 billion left on the last one, another $10 billion on top. So I think in terms of what Chris just said, in terms of Pedro's Power Pitch, Caterpillar looks pretty interesting.